You've been lied to. That's right. When it comes to investing, there's a lot of noise out there, and much of it is downright misleading. Think you need to be a Wall Street genius to make money? Or that timing the market is the secret to success? Think again. In this video, we're diving into the top 7 investing myths that have been keeping you from building true wealth. Stick around, because what you're about to learn could change your financial future forever. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. Myth number 1. Investing is like gambling. This is one of the most dangerous misconceptions out there. Gambling is about chance. Investing is about strategy. When you gamble, you're betting against the odds, hoping for a quick win. But when you invest, especially in solid companies or index funds, you're putting your money into assets that have the potential to grow over time. Yes, there's risk involved. But unlike gambling, smart investing is backed by research, data, and a clear understanding of market fundamentals. Myth number 2. Investing is only for the rich. This couldn't be further from the truth. Thanks to the digital revolution, investing is more accessible than ever before. Today, with just a few dollars and a smartphone, anyone can start investing. But the fact is, many people still think they need thousands of dollars to even consider it. Don't let this myth hold you back. Start small, be consistent, and let compound interest do the heavy lifting. Remember, the earlier you start, the better. Myth number 3. You need to time the market perfectly to make money. How many times have you heard someone say, "I'm waiting for the perfect time to buy"? The truth is, there is no such thing as the perfect time. Even the most experienced investors can't consistently predict market highs and lows. The secret is not timing the market, but time in the market. Staying invested over the long term is what really counts. Think of Warren Buffett's famous saying, "The stock market is a device for transferring money from the impatient to the patient." Myth number 4. Higher risk always means higher reward. One of the most common misconceptions is that higher risk automatically equals higher reward. While it's true that riskier investments can offer higher potential returns, they also come with a greater chance of loss. Not all risks are created equal. It can manifest in many forms: market volatility, economic downturns, or company-specific issues. Smart investing involves balancing risk with potential reward through diversification and understanding the assets you're investing in. Taking on more risk without a strategy or proper research can lead to significant losses. The key is not to chase high risk blindly, but to manage risk wisely. Myth number 5. Debt is always bad for investing. Now, don't get me wrong, high-interest debt like credit card debt is indeed detrimental to your finances. However, not all debt is bad when it comes to investing. For example, good debt includes loans taken out to invest in appreciating assets like real estate or businesses, which can potentially increase your wealth. On the other hand, bad debt involves high-interest loans that do not contribute to your financial growth, such as payday loans or credit card debt. The key is to differentiate between bad debt and good debt. Good debt can leverage your investments and enhance returns, but it requires careful management and a solid strategy. Myth number 6. The stock market is rigged against the small investor. It's easy to think the market is unfair, especially with headlines about insider trading and manipulation. However, the truth is that the market is fueled by millions of participants, including pension funds, large institutional investors, and everyday individual investors. Data from Bloomberg indicates that retail investors account for approximately 20% of the total trading volume in U.S. equities. Meanwhile, research by NerdWallet shows that a diversified investment strategy, such as investing in index funds, typically outperforms most actively managed funds over the long term. Although some players may have advantages, the market as a whole reflects the value of companies, And with careful diversification and a long-term approach, individual investors can indeed achieve success. And finally, myth number 7. Past performance predicts future results. One of the most misleading myths in investing is the belief that a stock or mutual fund that has performed well in the past will continue to do so in the future. Many investors mistakenly believe that past performance guarantees future success. However, markets are unpredictable, and past performance is not a reliable predictor of future returns. Countless studies have shown that the top-performing funds one year often underperform the next. For instance, the 2023 S&P Persistence Scorecard found that only 6% of U.S. equity funds in the top quartile in 2021 remained there in 2023. Additionally, fewer than 1% of large-cap funds maintain top-half performance over 5 years. Instead of focusing on past performance, build a diversified portfolio based on solid fundamentals, long-term goals, and strategic asset allocation. And there you have it, 7 investing myths debunked. Remember, successful investing involves questioning everything and doing your own research. Stay curious, and you'll make the decisions that are right for you.